Sandeep sir, good evening. Sandeep sir, good evening. Sir, you are mute.
Fine. So, ready?
Yes, sir. Yes, sir. Thank you, sir. So, how
Today
is?
you will be doing AVP presentation. है ना?
Yes, sir. Yes, sir. Yes, sir. Nidhi ma'am told me, so she will introduce the speaker. I will introduce our AVP. Then the speaker will take over. I will again propose vote of thanks. Maybe Nidhi ma'am will do, or I will do. One of us, sir.
Okay.
Sir, how is Bhave sir? Recovered? Good, sir.
नहीं 24th को उसका ऑपरेशन था ना ही
Okay.
तो मे बी वन मोर
One
वीक
more week. Okay, 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 sir. So we have time, sir. In fact, almost 20 minutes is there.
या फाइन
Hardly 6:15. Fine, sir. I'll stay online. And then as Nidhi ma'am joins, we'll take over, sir. Please.
या
Okay, sir. I'll go silent, sir. Please, sir. Thank you, sir. Thank you.
कैसे है सर राहुल जी? क्या हाल है? और बढ़िया।
नमस्कार संदीप जी।
क्या हाल है?
बस ठीक ठाक जी।
और फिट हो गए हम?
ऑलमोस्ट 1-2 दिन में परफेक्ट हो जाएंगे। फुल
चलो।
एनर्जी। अभी अपना मंडे का भी मीटिंग करना है। अभी कितने आ गए?
हाँ ठीक है।
7 जन आ गए ना। ओके। हाँ जी। आपके दिल्ली में तो ठंड हो रही होगी सर।
हाँ दिल्ली में तो 5 डिग्री हो रहा है।
शाबाश। हम लोग इधर 12-13 डिग्री में हिल जाते हैं तो।
देखो सरावगी जी ने कितने क्या क्या पहना हुआ है, देखो उनको।
किन्होंने?
राजकमल जी ने, वो एकदम दिल्ली वाले।
हाँ यस।
अंदर से बाहर तक सब कुछ पहना हुआ है।
हाँ ये वही ना बात। एक्चुअली ठंड मनानी भी चाहिए ना।
हाँ तो ठंड
ठंड
का
है
अलग मजा है अपना।
हाँ मैं बहुत मिस करता हूँ।
आप
खाने
जो है
पीने में बड़ा मजा आता है।
देहरादून छोड़ के बम्बई बस गए आप जो है।
सही बात है। हिम्मत नहीं पड़ती लेकिन ठंड में जाने की। बहुत ही ठंड होती है।
बम्बई में तो ठंड पड़ती ही नहीं है।
यहाँ पड़ती है सर, बहुत ठंड होती है।
हाँ पड़ती है, मैं एक साल बॉम्बे रहा हूँ किसी जमाने में, बट तो
नहीं तो ये तो 20 डिग्री होता है तो ठंड ठंड करने लगते हैं ना वहाँ तो।
नहीं, हमारे इधर 12-13 डिग्री हो जाता है सर टेम्परेचर।
अभी परसों तो दिखाया था वहां पे आग वाग जलाए हुए लोग बैठे हुए थे।
हाँ इधर ठंड हो जाती है। इधर प्रॉब्लम ये होती है कि इधर डस्ट बहुत हो जाती है, ह्यूमिडिटी बहुत कम हो जाती है।
हम्म,
डस्ट बहुत हो जाती है तो उसकी वजह से जो है ना इरिटेशन होता है थ्रोट में, रो सब। नॉर्थ में क्या है, बारिश होती रहती है ना,
हम्म,
तो प्रॉब्लम जैसे वो सूखी ठंड जो बोलते थे, और तो उसकी वजह से जो है ना इधर बहुत परेशानी होती है।
हम्म।
एकदम ड्राई हो जाता है इधर।
तो ड्राई में गला तर करके रखा करो तो ड्राई नहीं होगा फिर।
तो क्या कैसे तरक और कोई आए हैं क्या? निधि निधि जी इसको होस्ट।
हाँ निधि, निधि आज की कोऑर्डिनेटर है, वो बुलाएगी मैडम को। निधि इनको देख ले, डायना मैडम को।
देख रहे हैं।
और कौन है? भावे सर की कैसी है तबीयत?
अभी तो 24 को तो हुआ ही होगा उनका ऑपरेशन, अभी तो रिकवरी फेज में ही होंगे।
बताएंगे मेरे ख्याल नेक्स्ट वीक तक काफी ठीक हो जाए।
Yeah, he is doing very well. I spoke to him good.
अच्छा, चलो चलो, अब वो आते ही फिर चाबी भरेंगे। अभी तो सारे ठंडे हो गए, ना कोई बोर्ड मीटिंग, ना कोई कुछ कर रहा, कुछ भी नहीं कर रहा।
हाँ,
ना
तो
तब से न्यूज लेटर आया, ना तब से मीटिंग हुआ, कुछ भी नहीं किया किसी ने।
ऋचा जी को जरा फोन करता हूँ मैं।
हाँ,
हमारा सीएलडी का रह गया ना मैसेज।
वो आपने अपना मना कर दिया, दूसरे का उसने भी कहीं नहीं किया, वो भी ठंडी है कि आप कर लो, नहीं तो क्या है उसमें।
नहीं, एक वो प्रेजेंटेशन उनका करके फिर मैं करूंगा ना, मैंने उनको बोला था।
रखवा लो मंडे को ना, अशोक
हाँ,
का है या उनका जो भी मंजुनाथ जी का किसका था, दोनों में से किसी
हाँ,
का करा लो उसको।
यस, मैं अभी ऋचा जी को मैसेज कर ही रहा हूँ।
और कह दो नेक्स्ट आपका शेड्यूल कर दे, वो तभी करेगी फिर तो।
और कितने आ गए? हाँ, 15 गुड, काफी लोग आ गए। शुरू करें सर? अपने ये सीपी के सर्टिफिकेट्स नहीं आए ना लास्ट 2 टाइम के? आप म्यूट पे हो संदीप जी, म्यूट पे हो आप।
ये आपका कोटा पूरा हो गया तो फिर नहीं आएंगे ना बाकी।
अच्छा, कोटा कितना? 16 पॉइंट का?
16। हाँ,
अच्छा,
उतने ही देंगे ना वो तो।
अच्छा।
1500 में उनकी जान थोड़ी लोगे बच्चों की।
मेरा तो आरबीओ वैसे भी वही है।
अच्छा, चलो बढ़िया है।
अभी वो कुछ वैल्यू एक्सपर्ट करके कुछ बना लॉन्च कर रहे हैं, उसमें काफी प्रोफेशनल्स होंगे, वैल्यूएशन के कुछ कर रहे हैं, पता नहीं। निधि जी ट्राई कर रही हैं उनको?
हाँ, वो ज्वाइनिंग तो दिख रहा है, नेम तो आई डोंट थिंक वेदर एक्चुअली शी इज एक्टिव। क्या डायना मैथियास मैडम का ज्वाइनिंग में तो है इधर।
Hello. Yeah, I'm there.
हाँ, ओके मैडम, ठीक है। नाइस टू वेलकम इन एवीपी वेबिनार।
Thank you.
तो ठीक है प्रशांत जी, इट्स 6:30 ऑलरेडी, तो वी
हाँ।
शुड do the inauguration and starting, है ना? So I welcome you all in the webinar of Association of Valuation Professionals. Our association is association of mostly CAs, CS, CMAs and professionals are member of it. We who are mostly valuers, still person who are interested in valuation can become members of our association, and we have worthy guidance and mentorship also for the young members and the newcomers in the field. We have tie up with IIV RVO for CEP hours, and we have many scholars and renowned persons also as our member. Past president of BSc and past president of CMA, CS and ICI are also our members. Our president Ramon Bhaveji himself is a renowned person, and he is well versed and has worked in the Reliance Mittal Group and has traveled all over the globe, and he is active and regular speaker in webinars for various study circles and groups, particularly in the field of IFRS, and he is also expert in valuation. Our today's speaker, Diana ji, is also CA and is expert in valuation field, and will take us to the very interesting and useful topic during the webinar. So one can become our member by just paying 5,000 as fees, and it will be very useful that to be associated with us, as this is one-time fees, and we just hold hands and take together for knowledge sharing, and all our webinars are free, but for some specific condition for getting CEP credit. So without taking much time, I hand over to Nidhi, and Kishorji will do the AVP presentation and then proceed further. Welcome, Kishorji.
Sandeep sir, good evening.
Good evening.
Thank you for the nice introduction about our association and about Bhave sir. Dear members, welcome to the session. Let me give a brief presentation about AVP. All of you noted about AVP's brief intro from the talk of our respected professional committee member head Sandeep ji. The objective of AVP is to facilitate dissemination of knowledge about the valuation aspects and build culture of professional valuation among all the members. We have tie-up with IIV Pune, which is based at Pune and has been conducting valuation examination and certifying. And we have tie-up with SMB Chambers of Commerce, Chambers of India, which is a professional body striving for the benefit of the small and medium and enterprises. AVP gives life membership with only rupees 5,000. Let me add my own experience. When Professor Rammohan sir, Bhave sir, Sandeep sir and Nitin Brahma sir advised me to join, I thought I may not find time, and why should I pay 5,000 rupees to become a life member? Then they said, why don't you attend a couple of sessions? I attended one session and I realized personally that one session itself is worth 5,000 rupees. That was the value I derived from the first session itself. Then immediately I applied and I have been deriving the benefit whenever I find time. I am attending, and this is a fantastic association. No frills, straight subject and benefiting all the participants. Therefore, we request all the other professional members to also join AVP and strengthen the AVP for the benefit of everyone. And you know, we have achieved a lot of milestones. Though now newsletters are being published, and we have members from foreign countries and some of the past presidents of the professional bodies and lot of professionals, expert valuers, expert chartered accountants, expert company secretaries, cost and management accountants, and also some of the advocates. And until now we held 44 webinars, all world class pan India professional subject delivering webinars, and all of you got benefited with that. And this is a brief about IIVRE, of which all of you know, and SME chambers, which we just now spoke about. And the benefits of benefits of joining AVP we have already explained. You get access to free webinars, at least 2 in a month, and there could be more, and mentoring from the senior members through the group WhatsApp group channel, and also one-to-one. We are very happy to note that most of the young professionals are deriving valuable mentorship, valuable mentoring, and also a lot of tips and guidance from our seniors in direct windows. And they have been sending the thanks notes to the committee heads, who are very happy about the good fraternity, a good community which is built in the name of AVP. Thanks to our leadership, and we've been forming various study groups within the AVP also, and pan AVP, which is benefiting all the members. Excel group is one, DCF computation is one, and many are members of this. All of you are benefiting along with the new members who are joining. And also CP hours, credit hours are also being accorded in association with IIV, and the certificates are being allotted, issued in due course. We have conducted a lot of webinars until now, which you all know. Maybe from next time we'll include a brief slide highlighting the topics of the webinars which were held, so that members will understand, the new joinees and the new participants will understand what kind of topics are covered. Nevertheless, let us now look at brief list of the upcoming webinars. These are scheduled, there could be many more. Some of them include valuation under SEBI and Companies Act, valuation scenario post discontinuation of LIBOR, which is a very hot topic, company specific premium and discount or loss of marketability, discount or loss of control, etc., valuation aspects in union budget, financial modeling and valuation, startup pitches and valuation for overseas investors, valuation of preferred shares, Excel tools for conducting financial modeling, valuation of intangibles, valuation analysis and techniques, valuation methodologies, caveats, limitations, and disclosures in the valuation reports to be submitted, basics and techniques of corporate valuation, and valuation of cryptocurrencies. Further, greenfield valuation method and distributor method of valuation, valuation of brands, trademarks, goodwill, and other IPRs, practical issues in valuation of startups, valuation multiples, normatives, and capitalization rates in the valuation, funding and valuation of startups, regulatory framework, and the DIPP guidelines for taxation in startup valuation. So for these and anything else, you can always contact our leadership. You can also post any query in the WhatsApp group, and also contact them directly or by mail or by any other telephonic talk also. With this brief intro about AVP, and with the thanks to the leadership for the opportunity, we request Nidhi Agrawal ma'am to let the subsequent part carry on. Thank you, please.
Thank you, Dr. Kishore sir, for such a warm welcome and such a good introduction about our AVP. And I would like to, ask our member,
Hello. Nidhi ma'am, we lost you. Can you check
I
your
think
mic,
Mr.
please?
Rao will introduce the speaker for the day today.
Yes,
Yeah.
yes. I'm sorry.
Okay.
Can I request Mr. Rao, sir, to please introduce us eminent speaker for the day?
Yeah. Very good evening, and thank you, madam, for the opportunity. And it's my pleasure to introduce Madam Diana Matthews on this pleasantful evening. We all know, in spite of the presence of various techniques, it is inadvertent that our thought process drives to only discounted cash flow method for obvious reasons. Maybe the stakeholders would perhaps be very clear when we try to explain the same funda, whatever we did to them and all. And nevertheless, there are many constraints in this. So ideally, this is the topic Madam has chosen, and this topic is very apt for today's audience. And it's my pleasure to introduce Madam Diana. Madam Diana is the partner of NHI Associates LLP with over 12 years of experience and heads the business advisory and transaction structuring practice. Her focus area has been on valuations, corporate law advisory, cross-border advisory, structuring of inbound and outbound transactions, and transaction support. Her other areas of specialization include estate and trust planning and family governance. CA Diana Matthews in her career has done business valuations for joint ventures, buy-sell transactions, investments, merger and demergers, and regulatory valuations for income tax, Companies Act, and foreign exchange regulations across various industries. She also advised leading Indian conglomerates, entrepreneurs, and investors, including private equity and VC funds and family offices. She has addressed various forums, including Bombay Chartered Accountants Society and West India Regional Council of the Institute of Chartered Accountants of India, and is a frequent contributor to articles in various technical journals and online platforms as well. I feel that it is my pleasure to introduce such an young lady, and would like to hear from you, madam, and be enrich our thought process in the field of valuation. Thank you, Nidhi, once again for the opportunity.
Well, thank you, Rao sir, for such a kind introduction. And I would like to thank the entire AVP team, Sandeep ji, Nidhi, all of you all, Kishore ji, for giving me this opportunity. I would like to thank Bhave ji. I mean, he has really been an inspiration, and during the RV preparation days, I've heard him as a lecturer, and he's really inspired me. So really grateful that I've got this opportunity to be addressing all the members on this platform. And I'm sure that we will try and enrich ourselves with this knowledge sharing session. And if any at any place people have a different view, very happy to discuss and deliberate. As you know that no one view can be a final view. So I will try my best to address all these issues. So I shall just share my screen. Yeah, is my screen visible?
Yes, visible.
Yeah. Okay, so as the topic suggests, it is focused on the DCF valuation. And as rightly said by Rao sir, that more often than not, as valuers, we tend to always tilt towards the DCF valuation. And when we do these valuations, it's very important not only to understand how to do it, but also to understand what all challenges we would face while doing the valuation. And understanding these challenges will help us do the valuation in a much more better and standard way, rather than just applying blindly the formulas that are there. So the topic that I will be covering would be firstly a brief on the valuation requirements, the different valuation methodologies, and then the entire focus would be on the DCF valuation and the challenges. I would also be taking you all through certain examples through the Excel modeling that I have prepared. So that will give an idea in terms of practically, how these challenges work and how can we address these challenges. And lastly, instances and sectors where DCF method cannot be used. That is also important to understand that, all sectors and all instances DCF may not be the apt valuation methodology. So we need to be careful how we apply DCF in every situation. Coming to the valuation requirement. Now, we all know that, promoters and entrepreneurs spend considerable amount of time in developing their entire business. And along the way, they would want, to grow their business. And for that, they would require funding for their businesses from either angel investors or private equity, or they would want to grow inorganically. So they would want to acquire new businesses, they would want to divest certain businesses, and lastly, they would want to monetize whatever they have built. So from that perspective, in all of these aspects, valuation is required for the promoters to also understand, what are the actual business drivers that will help them get that valuation. So from a securities perspective, these are the various securities that one would value. So equity shares, preference shares are the normal ones which we have. In the current scenario with so much of foreign investors, hybrid securities are the norm in terms of optionally convertible, be it debentures or preference shares, compulsorily convertible, a preferred stock with a preferential liquidation right. So there are various nuances which a hybrid security can bring to the table. We have intangibles when new businesses develop certain intangibles and they want to monetize on that intangible, or they want to sell their businesses. Even at that point in time, valuation is required. And lastly is the options. So whether you're dealing in derivatives or you're dealing in a share-based payment, that is an ESOP payment, you require to do a valuation. So these are the various commercial requirements that you face when you want to do a valuation. From a regulatory perspective, we know that any kind of transaction today, you require a regulatory valuation, be it Companies Act, if you are going to do a private placement, if it is going to be a listed entity, you need to comply with the SEBI regulations. If there is a foreign investment, then you need to comply with the RBI regulations, both from a foreign direct investment perspective or from an overseas direct investment perspective. Not only on issue of shares, in the event of transfer of shares as well, you need to do a valuation. Business combinations, any merger, demerger, you require a valuation to be done from company law, SEBI perspective. For financial reporting, you need to do a valuation from Ind AS perspective to recognize if you have done an acquisition, to recognize the acquisition in the books, you need to do a valuation. So, and lastly, the ESOP and the sweat equity. So these are all the regulatory framework within which you need to do the valuation. In some regulations, the valuation norm has been prescribed, like for example, in case of an Income Tax Act, where you need to issue shares under 56(2)(7)(b), though it's a merchant banker who can do it, but their income tax has prescribed specifically to provide a DCF valuation. Whereas other regulations like RBI and Companies Act, they have left it completely open to the valuer to decide based on the internationally acceptable valuation methodologies to apply the valuation on the particular company. So this is the broad framework that we need to understand prior to get into the valuation, is from which perspective are we doing the valuation? Are we doing the valuation from a regulatory perspective, or are we doing a valuation from a commercial perspective? Once we understand that, what are the various methodologies, just a brief, that we have, as we all know, the market-based, income-based, and asset-based methodologies. Market-based is when you compare with the comparable companies, whether in the listed space or any transaction that happens in the unlisted space, and then you apply that comparable transaction to your own transactions. That is a market-based approach. Asset-based approach, is when it's an asset heavy or you're going into a replacement from a liquidation perspective, you would use the asset-based. And then lastly, which is the most common used, is the income based approach. And within that also, depending upon if you're valuing an intangible or you're valuing a sweat equity, you would use the other methods of multiple period earnings or with and without. But the basic principle in all of these, always apply the discounted cash flow methodology. So that is the prime in the income based methodology that is applied always. Now, what is the discounted cash flow methodology? Under the discounted cash flow methodology, it says that the assumption is that there is an asset and that asset generates income, and that income generates ultimately cash flow, which either you will reinvest into the business again so that your income increases further, or you will dividend it out, you will distribute it to the shareholders. So basis those cash flows, you try and analyze what is the worth of the business. So this is the basic fundamental premise of a discounted cash flow method. But having said that, we all know that valuation is a very tricky subject and very difficult subject, because ultimately, what are you valuing? You are supposed to put a price on a business, which is all about expectations, right? Expectations in terms of what a promoter would want vis-a-vis what an investor would want. So different people will have different expectations out of a business. So how, as a valuer, you will try and address those expectations, or those expectations, how certain are those expectations to actually turn into reality? So these are some of the factors that goes into understanding that how can we apply a discounted cash flow methodology. The valuer has to apply a lot of judgment in doing this methodology. So though this is widely used, but it also with it carries a lot of challenges. So the advantages, firstly, for DCF is that it values the intrinsic value of business. So basically, it is not comparing with any market peers. It is valuing what cash flows it can generate, right? So it is completely only dependent on its strength. What is its strength? How much revenue it can generate? How much cash flow it can generate. So it does not require any comparable companies per se. And this is the only method which captures the full potential of a business. The market method, that is based on the current position. But what about the potential that is going to come in future? That is something which the discounted cash flow method tries to bring it into the current forum. Also, you can do a lot of sensitivity around the discounted cash flow methodology to understand the variations that can happen within the valuation. So that gives an idea of the range that the valuation can move. So that is something which acts as an advantage. But from a limitation perspective, it is highly reliant on a future forecast. As I said, that future forecasts are completely uncertain, right? We do not know what will happen in the next 2 years. I mean, nobody had ever envisaged that a COVID-like situation would happen and it would derail so many businesses, or it would actually accelerate certain businesses due to this situation. So there are so many unknown factors that are there, which cannot be completely forecasted when you are sitting today and you have to do a 5-year, 4-year forecast period. So because as we all know, whatever you garbage in, garbage out, so whatever you will give the inputs into the DCF model, it will throw out those results. So that is the biggest limitation of a discounted cash flow, wherein we have to rely on future forecasts. Second is complex valuation parameters. we have to consider n number of parameters to arrive at one value. So it is just not so simple that you just take a comparable, add a multiple, do some 1 or 2 adjustments and you get a value. No, we have to first, I mean, there's an entire process that I will take you all through. So that requires a complex understanding of the entire subject. And since it's subject to so many adjustments, you need to be very careful in what is the value that you're going to, ultimately derive and provide as the value of the company. As already mentioned, that valuation is in isolation. Now, sometimes when you look at it as a positive, it can also act as a negative, wherein you are not comparing with what is actually happening in the market, right? I mean, market situations change, market dynamics change. So depending on the situations, sometimes the valuations also change. But DCF per se, since it's more of an intrinsic value, it does not compare with what is happening in the peers, right? So from that perspective, it may happen that only relying on DCF valuation, you may be off the mark when compared to the market. And lastly, since there are so many variables attached, it is prone to errors. Any error in the model can really off balance the entire valuation game that you will be doing. So these are the limitations of DCF, and that is why we have to be very, very careful when we are going through the DCF modeling. So what is the typical valuation process? So first is definitely to understand the purpose of valuation. So as I was mentioning that, for whom are we doing the valuation, or for what purpose are we doing the valuation? Because every purpose, the viewpoint changes. The view of what the valuer will look at will change. For example, if your purpose is to sell off the business, correct? So when your purpose is to sell off the business, the valuation has to be looked from that perspective. If you want to raise funds in the business, then the entire purpose again changes, because now your objective is to raise funds for further growth. So you will look at the projections differently. When you're going to sell the business, you will look at the projections differently, because now if the promoter is being replaced by somebody else, will it impact my business? So the purpose is very important first to understand before you get into analyzing the projections. Then is information requisition from the company. As far as possible, we should get the entire business model from the client, so that we are in the reviewing position and we are not, and validating position, and we are not making the business plan, because that would get into a conflict position. We have to get the complete business plan from the client. Along with that, all the issues and whatever information which requires for the valuation should be sought. So historicals, your financials, your IT returns, any matters which affected the business during the past. So those information should be gathered. Third is understanding the industry trends and financial analysis. This is also very important, because unless and until we understand the industry and the trends, we won't be able to analyze the company properly. Say, for example, if you are doing a power industry discounted cash flow, you have to understand how the power industry functions. You have to understand the terminologies, the technology that is going, what are the current trends, what are the current practices, how the business is being generated. The entire model needs to be completely understood. The industry trend needs to be understood. Forecasting and validating, as I already mentioned. Then is applying the appropriate valuation methodologies. And lastly is performing the valuation adjustments and conclusion and reporting. So this is the typical valuation process. So this is, just a snapshot of a DCF model that one would have. So you have a projected cash flows. So for example, over here, we've taken from 21-22 to 25-26. So there is a 5-year projection. We've got the revenue, operating cost, then operating EBITDA, depreciation, profit before tax, income tax, profit after tax, depreciation, decrease in working capital. And this is the basic projections that you have. And on the other side, we have all the assumptions for the valuation. So first is the horizon period that is required. Then is the cost of capital, the perpetual growth. What is the perpetual growth rate that we are going to take? The terminal value, that is the major portion of DCF valuation. Then is the adjustments that we do in terms of any control premium or illiquidity discount. And lastly, the number of shares. So I have picked up these because these are the places where a lot of challenges are faced and a lot of issues also arise. So let me take the first one, which is the horizon period. So always the question is, what should be the horizon period? Should I take a 2-year horizon period? Should I take a 3-year horizon period? The client will say, I don't know what is going to happen after 3 years. How can I project 5 years? And we insist that we require a 5-year projection to understand. So what is the right way to approach this? That is the first question. And that is something that we need to understand. What is the fundamental of DCF? So the fundamental of DCF is that you have to value the company till a stage wherein the cash flows are a stable cash flow, right? So the projection period should be such that at the end of the period, you are reaching to a stage wherein the cash flow or the revenues are a stable growth and a stable cash flow, which will go on to perpetuity, because that is what you're going to do at the end. So if you take only a 3-year horizon period, which completely does not explore the full potential of the business, then you have not fully given justice to that business. Say, for example, so I will is my Excel sheet visible?
Visible.
Yes, ma'am, visible.
So I have just created, a dummy kind of a model to make you all understand. So I've just created the balance sheet and the P&L with all the assumptions in terms of the growth. So over here, as you see that, it's a projection wherein your EBITDA as a percentage to revenue is increasing. So it increases from 14% to 24%. And assuming that the client feels that, this is what is achievable and it is achievable throughout, this was the early stage wherein a lot of investment is required. And along the way, 24% is something which is sustainable in future. Now, having this model, if we are going to do a 2-year horizon versus a 4-year or a 5-year horizon, how does it look at? So I have just so this is so if I only have taken till March 23 as my horizon period, that is only 2 years hence. Okay, so today, say for example, in January, we are doing the valuation, or December end. So I have got 2.25 as the number of years of period. And assuming that, because I have not fully explored the entire potential, I have put in a bit higher growth rate compared to if I would have done a longer period, horizon period. So basis that, I get an equity value of, say, 25 crores. Now, same thing if I were to do for a 4-year period. So if I do for a 4-year period wherein I have taken the present values for the entire 5 years and I have considered the 5th year of the terminal value. Here I had considered, sorry, I have taken this 2.5 years. Yeah. So I have taken this as the terminal value. So basis that, if you see the difference that it brings to the valuation. So the 25 crore valuation has now increased to 30 crores. So there is a 19% difference in valuation because we have considered a different horizon period. Now, similarly, what if this was a reverse kind of a business wherein instead of a growth, we would have seen a decline, right? So even in that position, what would have happened is I would have overvalued my business today because I have not considered that there could be that this is the peak of the business and there is in fact going to be a tapered growth which will then become stable. So in that scenario, I would have overvalued my company today. Like in this scenario that we have undervalued the company by taking a lower horizon period, here I would have overvalued my company. Now to this, if you see, I have just done a sensitivity analysis to understand that with varying terminal year cash flows, how does my equity value changes. So with different growth rates and the different terminal year values. So if you see over here, my terminal value is 542. Okay. Or here is 338, which falls somewhere around this bracket. So with every 15% upward variation, we see that there is a 9% change. And with every 15% downward variation, we see that there is a 10% change. So the valuation is moving from 24 to 29 crores. And when we have a 5 year, this is when we are talking only for a 2.5 or 2.25 year period. Within that, okay, if say for example my terminal value would have shown a different growth, so I'm just trying to do a sensitivity within that values to see instead of 338, if I would have overachieved, then how my valuation would have looked, and if I've underachieved, then what my valuation would have looked. So there is a delta of 24 crores to 29 crores. Now same thing when I do for a 5-year-old period. Here the variation with 20% gives me the same change which I was doing here with the 15% variation. So this we have to then see what is the actual valuation, by comparing these sensitivities and understanding what is the range that is happening. So the 27 crores, which is a mid path over here, is the lowest point in case of a 5-year-old. So we need to understand from the client what are the probabilities and how are they conservative, are they aggressive, are they realistic, what basis that they have estimated that this growth can be achieved, what is the trend, have they got any peers to show that this is a sustainable growth. So these are certain things that we need to question so that we do not just do the evaluation just by putting the numbers. As mentioned over here, as shown over here, that we are getting a 19% delta. So for that we need to be completely clear that what we are projecting, a double growth, is that possible or not possible. So that is something definitely we have to get from the management, but we also need to be comfortable with that, with all the supportings available. So that was one position to show that varying horizon periods can differ the valuation. Also, the horizon period depends upon what is the nature of business. Is it a fixed life business? Is it a perpetual life business? Is it a cyclical life business? So now what I mean by fixed life business, say for example, the company has only one real estate project. Now we know that that real estate project is not going to go for perpetuity. There's going to be just one project, and like an SPV. So that will have that limited life of that project. So if the real estate project is going to get completed in a 5-year scenario, I will only consider 5 years. Or if I believe that in 3 years it will be completed, then I will consider 3 years. So we also have to understand what is the nature of business that we are valuing and accordingly determine the horizon period. Perpetual life business, as I mentioned, that we need to have the horizon period till the time that we believe that the projection or the cash flows will reflect a stable growth business and there are not much variations within that. So that is something that we will see in the perpetual life business. Next is cyclical life business. Now, in case of cyclical life business, because you may be, when you are doing the valuation, it may happen that you are doing at the peak of the valuation, right? Now, if you're doing at the peak at the valuation, you need to understand what has been the entire life cycle and when will that peak come to the tapered growth. So that entire life cycle needs to be considered when you're doing the projected cash flows for a cyclical business. Then we need to understand what is the stage of business. So definitely if it's a new age business, that's just a startup which is venturing into a high tech or a new technology, the initial period will definitely be a high growth. But can I consider that for my horizon period? Say, for example, I believe that the next 4 years will be high growth. Now, in the 5th year, I can't show a drastic drop from that high growth, right? So we need to understand from that high growth, how will the next growth cycle happen? How will it gradually taper down? Or we believe that there would be some competition and there could be some challenges and therefore there could be some drop in the growth. So all those factors needs to be understood while taking the projections into consideration. Next is near to maturity. So if definitely a company which is in a mature business or just nearing to maturity, it is very easy for such businesses to have a stable growth, and there may be 1 or 2 years of peak and then a gradual decline. So that can be factored. And in case of businesses which are already reached its maturity or there is a saturation, now there we need to see, is there a tapered growth that is required, and to what extent will that growth be tapered, right? Is there a position that growth will be sustainable after a point in time, or there will be some other options that business may not be workable in future, and it may also go for liquidation. I mean, all of those things we need to understand, and that can only come in with the understanding of the industry and the business that we are valuing. The next is the valuation date. This I have added the point because I have generally seen that people just take the year-end balance sheets and they just project the financials, the year-on-year the model, and then they just discount without understanding whether they are doing a mid-year valuation or they're doing a year-end valuation. So if you are doing a mid-year valuation, say for example you are doing a valuation in September, then you cannot have a full year discounting. So you need to adjust the discount to reflect the period for which you are discounting the cash flows. So that we need to be very careful of, that we need to then from September to March, we need to have the projected financials. Until September, you take the actual financials and only discount for half a year for that period. So this is something that we need to keep in mind, because this is something that I've observed people do a lot of mistakes. That is, they do not consider the point in time when you're doing the valuation and the discount factor that you're applying, whether it is adjusted for the period of the cash flow being considered. So this was the horizon period. The next challenge that I had reflected was the projections. Now, projections is the base of our DCF valuation. So definitely we have to spend a lot of time in understanding those projections. Now, before we go to analyze those projections, as a valuer, we need to understand the basis of those projections. are those projections certified by the board, or are those projections submitted to banks or investors? We need to be privy to this information, because it can happen that the client has submitted X projections to the banker and it is giving us Y projections. Now, in that event, I mean, if they have given a different picture to the bank and a different picture to us, anybody can question the validity of those projections. And therefore, it is very important to ask the client, are these projections which they have made have been submitted anywhere in the last 6 months, right? So that is something, because we need to understand the authenticity of those projections. Are these projections board certified? Board certified, that shows that the board has taken the cognizance of these projections and they really want to act upon these projections. So it's just not numbers being plotted for the sake of it, but it has got the entire relevance attached to it. So that is something that we need to start the entire base with. The second is the industry potential. Depending upon what industry you are and what is the size of the industry, what is your market share in that industry. So that will also help you analyze, are those projections being too aggressive or are those projections being too conservative? We need to understand it, and that can only come with a sense of the industry. If the market size itself is $100 million, I cannot have a projection which shows that I'm going to reach $100 million, because there are always going to be market players, competition that's going to come in, and that's going to drop my market share. So we need to be very wary about these factors when we consider the projections. Next is customer profile. So this is also important. Sometimes we get clients who have just 2 clients. I mean, they have a lot of business, but ultimately they are dependent on 2 clients. Now, when you get a projection with a company which has only 2 clients vis-a-vis which a company which has 25 clients, your perspective has to change, right? Because any impact on one client, we have practically seen that a takeover happens of the client and the new acquirer is not interested in giving you business. So your entire company crumbles. So diversification is required to de-risk the entire business risk that you are taking. And accordingly, this will help us to understand what kind of discounting that I need to give to the valuations. So very important to ask the question that whether you have a concentrated customer profile or you have a diversified customer profile. Do you have a retainer customer, or you need to have, or you every time need to scout for a customer? So definitely, if you have a large retainer base, you are assured of the consistency of the projections that are going to come out of it. But if it is going to be a new acquisition all the time, so you know that there could be times that a lot of effort or business development that would be required to every time get hold of customers. So that gives an added risk, because every time you have to go to the market, go to prove your potential and attract the clients. So this is something that one needs to be very careful about. Next aspect is whether your cash flows, always clients will ask us that, what is your cash flow based on? Is it based on post money or is it based on pre money? So here, if anybody can, answer whether it should be a post money or a pre money.
Pre money, ma'am.
Okay, anybody else?
It's post money, madam.
Okay, so I've got 2 different views. Okay, so no, so
it's actually post money, then we will arrive at pre money.
Correct. So that is right. So basically, what are you valuing? You are valuing the potential of the business. So unless and until you do not value the post money potential, I'm not talking about what is the valuation that you're doing. You're doing a pre money valuation. I'm talking about the cash flow that you're going to use. If I'm doing 100 rupees business today, will I project that I can grow at a CAGR of 40%, 30% without having the cash? Or with my cash and with my resources, I can grow from 100 to maybe a 10% growth. So what should I consider in my projections? So a true valuation is that where you believe that without much effort, based on whatever potential you have, you would be able to take the company from X to Y. So that is the post money cash flows that you need to ascertain. So you have to tell the client, you determine what is your potential. Forget about funding and everything. That is a consequence. They get always confused with the funding is not there. Then how can I value? How can I project it? So we have to make them understand you don't worry about funding, but without funding, what is your potential? Currently, you show it as loan. We will discover that. It is a discovery mechanism, right? So that will help you understand the true potential of your business. So cash flow will be on post money potential, and because you will have a negative cash flow in the initial period, right? Because you have not raised funds, so definitely you will have a negative cash flow. But that is the entire essence. You have captured the upside in the future, and you have to bring it back to the present by understanding that future cannot be achieved without this cash, and that is why it will bring down the valuation and bring to the actual valuation. So that is the entire concept, if I'm able to make you understand. Next is cash flow to firm or cash flow to equity. So both methods people use, and it depends upon what is the leverage that you are going to have. And usually we say if it is a very high leverage companies, then you have the cash flow to firm, so that you do not, because you have to otherwise predict on how the cash is moving and the fund requirement. So from that perspective, cash flow to firm can be used, but again we will have challenges in VAT, which I will come back to. But in a normal scenario wherein you have a normal growth and a normal leverage, you can also do the cash flow to equity. Next is trend analysis. So once the projections are there, you need to also do a trend analysis, that is analyze your historicals, analyze the market that is there. So if you have in the past only been growing at 5%, you cannot have a 20% growth, right? Or if you have been growing 20% in the past, or your Ebitda margins are distressed, to suddenly assume that you are going to make robust EBITDAs, that is also not digestible. So you need to really understand the historicals, and what is it that happened in the past and how is that going to impact your future. If there is a variation, we need to understand why is that there a variation, what are the steps that the management thinks that they would take to address those aspects of past and which will not come in future. So that is something that is required, and I have done some templates which I will take you all through as well. Then is the capex. Now again over here we need to understand what is the capex being projected. Is it a growth capex? That means, is that capex going to enhance my capacity? Or it's a capex which is enabling me to conduct my business on an as is basis. So it's just enabling me to run the business. So this is really important, because say for example you show a huge capex and the growth is not there. You are showing that you are going to reinvest the entire funds in a new plant or a new machinery, but in your revenue projections in the horizon period, there is no growth about it. So definitely at that time you should question, you have captured this in the cash flow, you have reduced the cash flow to that extent, but where is the potential of that being captured in the projection? So your DCF should capture the entire growth story if there is a huge capex that has been invested in the horizon period. Terminal here this is also very important, and I will also come back to that separately. But in the terminal year, we have to be very, very careful what is the cash flow. And I've seen a lot of mistakes being happen in the terminal year, where terminal year cash flows are not being properly analyzed. So in the terminal year, you cannot have a huge capex, because that terminal year is supposed to be estimating a perpetual cash flow. So a perpetual cash flow cannot have a huge capex. It has to determine based on this position, whatever position you have reached, what is the potential. More than that, we cannot go into infinity. So that last year needs to have the proper cash flow determined. The tax rate, if you have been having a tax holiday during the horizon period, it doesn't mean that in perpetuity you're going to enjoy the tax holiday. So from that perspective, sorry. Yeah. So from that perspective, this will have the tax impact that you need to address over there.
Ma'am, you are taking the questions now, or you will take it at the end of the session?
You can raise the questions now also.
Okay, ma'am. So shall I raise some of the questions which is being asked?
Yeah, sure.
So, ma'am, Amita Mystery has asked, what is control premium?
I will come to that. That
Okay.
will, yeah.
Okay.
So if whatever I have covered, if any question regarding that, then I can.
Okay, ma'am.
Yeah.
Next question is, what is paid in excess of value if substantial shareholding is being sold? Say 11%, 26%, 51%, 76%, and 91%, etc. This is being asked by Mr. Kishore.
So this will also come in the discounts and the premiums section. So I will cover it there.
Okay, ma'am. There is one question on Dcf valuation. I have been listening that in Dcf valuation will be called post money. In such case, how to arrive at fair value? The existing holding will be considered, or the enhanced number of share will be considered? Please explain with example.
Sure, I will be explaining that as well.
The next question is, it means in projection, the projected cash flow from proposed equity should not be considered. Am I right?
Correct, yes.
Okay. Cash flow will be of revenue. The capital cash flow will be of loan or equity will not be considered. However, capex to be invested, additional working capital to be invested should be deducted from the cash flow, free cash flow. If any working capital get released after some time, that can be added back in the year of release. Similarly, the salvage value can be taken in the year of salvage of the asset. So, shall I request Dr. Kishore to ask the question personally over here?
Yeah, it's the same question, ma'am. In fact, no, I just tried to reply.
Yeah.
You have already explained this part.
Yeah. Any capex or working capital is always a part of the adjustment in the cash flows that is done on year basis. The only criteria that I was mentioning is that in the terminal year, there should not be a very drastic change in your working capital or a drastic change in your capex, because that really impacts the entire valuation.
Correct, ma'am. You explained it in the sheet also.
Yeah.
Thank you.
So I will, let me just take you through the sheet and I'll then come back to the last 2 points over here. So here I have done 3 kinds of projection. So one is a conservative or a tapered business projection, and second is a realistic, third is a aggressive business projections. Okay, so So if you see over here, revenue from operations, they are dwindling. So from 8%, they are going down to 6%. And the client mentions that revenue generation is difficult, but I have to also retain employees, and for that I have to incur the cost. So from that perspective, if you see, the Ebitda margins has reduced from 16% to 4%. So this is one data point that is there. Now we go to the cash flow. Okay. So this shows that there is a peak in the cash flow, and then there is a drastic drop in the cash flow, right? From 97, it has gone down to 36. Now, because of that, so the current valuation based on this 36, it comes to around 8 crores. Right, and we have this control premium liquidity, which I will explain later. So it is at 788. Now, if I apply, okay, and over here, if you can see, so to the profits, I have done the adjustment of add back the depreciation, the working capital, and the capital expenditure. This is a free cash flow to equity. For a simple sake, I have kept free cash flow to equity. And these are the two adjustments. So if you see over here, the working capital changes, whatever working capital changes are there, that is captured, and the capex requirement has got captured over here. Okay, now in this case, if you see that since this is a very tapered terminal here,
someone is asking, Mr. Rajan is asking, as a good practice, capex in the terminal year should be considered equal to depreciation.
Yeah, I mean, people do that. That is also fine. Because that you believe that whatever wear and tear happens, you will be replacing it by the capex expenditure. Yeah. So this is, I have just shown that. So first, to analyze the trend with regards to the revenue growth.
Just a question, ma'am. In case if we see an industry which is growing at a pace of like 15 to 20%, 15%, can a company which is in the same industry can grow more over and above the rate at which the industry is growing? Is it possible? Like if the industry trend is 15%, and is it possible that the company can grow at the rate of 20%?
So it all depends upon the industry and what is the businesses, the company in question, the USP compared to the industry. So it's not a complete no that it cannot happen. It can happen, but that has to be analyzed in greater detail, that what is it that it is doing differently, that it has been able to surpass the industry standards. Okay. So see, industry is an average of various companies, right, which has a low or high, all of those companies. So I may be at a higher end, and therefore I am at the above the industry average. So that is also quite possible. So that's not that is not possible.
So in that case, we should look into minute detail.
Absolutely.
Regarding the projects.
Yes,
like how fast they are doing.
Yes, that gives us an indication to ask a question. If we know ki it is industry to industry, then at least we have a comfort ki it is industry comparable. Now, if it has gone above industry, then definitely we need to question ki why do you suggest that it is above industry? It can also happen that past trend suggests. So we need to see ki is it in the past, have they achieved that, or are they only giving the projection? So they have to
also, ma'am, the order books which they have in their hand, that also give an indication.
Absolutely. And also this.
Ma'am, it also depends on the life.
Correct. I was just going to say that you cannot have it that somebody is going to outgrow the industry forever. There is always going to come a stage wherein you will reach to a saturation level, or there will be barriers in the industry, or competition will increase. There's always going to be that case. It cannot happen that for perpetuity you are going to be able to get the best growth.
Yes, ma'am. Yes, ma'am. True. Thank you, ma'am. Thank you, ma'am.
So over here, we have a 5% in the terminal year. I just want to show from the terminal year perspective, because terminal year gives the highest component. So if you have a 5% and a 9%, now if I compare that if my 5% were to become 9%, or my employee expenses were to reduce, then what impact does it have on my valuation? So if you see, because they have tapered the growth to such a low level, a small change leads to a higher variation. So from a revenue perspective, 7.8 can go up to 9.4 or 9 with just 2% increase in revenue. So that's a huge jump. So that is why we need to ascertain what is it that why this industry is showing that it is going to go so low. So proper justification is also required. Just because it is shown a taper growth doesn't mean that it may be right. I mean, they may have whatever objectives, but we need to be clear that when there is a past trend suggesting a particular growth, how can you keep on saying that you're going to degrow? So that is also something that we need to take care. So from a revenue perspective, still the gap may not be such large than in the projections of your cash flow for the working capital. See, ultimately, what is DCF? DCF is valuing cash flow. You can show that you're growing at 20% CAGR, but if your working capital is not supported and you do not have that adequate cash flow, your DCF will plummet. So accordingly, this is the most which will have the bearing on the valuation. So when the trade receivables, so if I'm saying of my revenue, trade receivables will be around 24%, so that is around less than 3 months, or a trade payable will be at 15%, which is a very low trade payable that I'm going to repay all my creditors at the earliest, but I'm going to get a delayed payment in terms of my debtors. Now, if that position were to change, so if my trade receivables were going to become better, right? Usually you could say that, it could be maybe 60 days or 65 days, which comes under this parameter. Your valuation changes, even a 2% change leads to a 20 to 25% variation. So 7.8 crores can go up to 11 crores.
Ma'am, just one more question. So while doing the DCF valuation, is it advisable to, do the sensitive analysis for each and every, minute, expense as you are doing rightly, ma'am? And we can understand that for each and every...
We have to, yes. So at least the major components, like for example, the Ebitda margins. Okay. We have to see what is the Ebitda margin. So the parameters, like I have seen over here, I have plotted over here. So one is, what is my Ebitda margin? Now, when I see that my Ebitda margins are going down, automatically I will see, okay, how is my revenue growth? How is my operating cost getting factored? So these are the two parameters that I have checked. And the second is your trade receivables and your trade payables. These are 4 to 5 parameters which are essential to understand how your cash flow is moving. And there are not many parameters. You just check these parameters are working capital components. What are working capital components? Because working capital components affect your valuation the most. So you need to really understand. See in this case, the trend, the past trend is, it is at 15% trade receivables, but they have increased it to 24%. So that means they are saying, I'm not going to rate my receivables and lowering my valuation. Now, this is something that we need to be really wary about. How has been the trend? If the trend has been otherwise, why the otherwise is being projected in the projections? So that is why you require to do a sensitivity. If it is off the mark with your past historicals, then you do the sensitivity to see how much variation it can happen.
Ma'am, in that case, in the previous example which you have shared, the previous page, where you have done the sensitive analysis for trade receivables, and it is increasing. So actually, it is reducing my valuation as you
Yes.
rightly said. So, ma'am, in this case, we should ask the client the question, and we should not, reduce it. We should maintain a, a margin like 21% or the average. Maybe we can advise
Yeah,
them,
that's
right?
what we have to talk to the client to say this is really giving a lot of impact. I mean, today at 15%, you were going to be a 15 crore company, and by reducing this in the projection, which is a 5-year hence, which you do not know, you are bringing the company valuation to 50%. So how, as a valuer, can I justify that this is a probable situation? So unless and until he tells me, no, I have shifted my base of business, my customers are now become, say, government customers, or there has to be a proper rationale for whatever is being projected, is the only submission.
Thank you, ma'am.
Just to add,
Yeah,
the objective of conducting this valuation is to bring out as close as possible a realistic valuation.
correct. Yes.
Therefore, as our speaker has mentioned, after doing the sensitivity analysis, when we understand that there is a high risk, maybe you'll be a bit conservative or realistic in pulling down the valuation or bring it to the realistic part. If there is an upside, like how one of our speaker mentioned, the order book or the technology you are growing faster or higher than the industry, then you will give a bit more premium. Sensitivity will be towards the higher side.
Yes.
So, sir,
Thank
in
you.
that case, all the inputs will go to the cost of capital, right?
Of course, no, not
This
necessarily,
first to just understand the cash flow.
Exactly.
Now, just one question. With so many variables coming in play in this DCF valuation, and generally we are advised to give a single valuation number. So technically, even if you see your this one, the valuation ranges from 7 crore to 15 crores. There's a huge gap.
Correct.
So does it really make sense to give a single number in a valuation report rather than giving a range between, say, because you make assumptions on your growth rate, you make assumptions on your working capital.
Correct, absolutely correct. That the valuation model is filled with assumptions, and we are only trying to get as much as close as we can. Even after that, there is no guarantee that this is the actual valuation. So people, yes, we do give a range. But again, it cannot be such a wide range. Also, it has to be within the benchmark range that can be given. So people give 5% or 7% up down, but that also needs to be checked. Now, from a regulatory perspective, usually they do not prefer a range, so that becomes a challenge. They want to understand. Say for example, from an RBI perspective, if I give a range, now they say that if your foreign investor is coming, he has to invest at a price higher. Now at a range, then now which range I will take? I will take the higher end only. So that becomes a challenge. When there is an Income Tax Act, it does not allow you to give a range, right? So there are challenges which we have to face. So ultimately, it is only through these methods. I will be even explaining some other aspects, so that builds the confidence in when we are giving the valuation.
And with regard to this working capital assumption on the debtors and receivables and the credit, in case of a manufacturing company, the stock statement or the drawing power which they would have submitted to a bank, or a CMA projection which they would have submitted to a bank, can be a basis for the working capital sanction letter itself will give what is the assessed banking finance, MPP, of what they arrive at. So can that not be, see, why I'm asking is, like, there are two things. One is we are assuming an as-is various basis. If the company grows at, say, X%, Y% going forward, you achieve a certain valuation. Now, this is assuming there is no additional money coming in, or there's no, we are not considering equity infusion per se in the projections when we are arriving at the valuation. So it's a kind of an irony, because unless there's an infusion of capital, I cannot grow from X% to Y%. Now, in that situation, ultimately, when you go and approach for a valuation, generally company expects growth from, say, 10% to 20% in the next 3-4 years, 5 years kind of a thing. That growth can come only when there is an infusion of capital.
So there, sir, what happens is, see, there is called a retention ratio or a reinvestment ratio. So for example, I have see today, what is this DCF? It assumes that these cash flows are being distributed. Okay. So if these cash flows are distributed, they are not available to the company. So that is why whatever growth it is doing basis its own whatever it is retaining. Now, if a company is in a high growth and is not taking an infusion from an outside source, but because it is in high growth and it has got a good cash flows, it is reinvesting that cash flows back into the business, then you can justify a high growth. So in that case, there will be another line item, which will be reinvestment into business. So the cash flows, year-on-year cash flows will be reduced because that is getting added to my growth in the future to get a larger growth. So that is how it happens when you do not take infusion from outside, but you are doing organic growth within the company itself.
Okay, this excess cash, whatever is generated out of the operations, either it can go into capital expenditure or
Correct.
the company can put it in the long-term investment.
Correct.
Now, if I
So
change
it is reserving itself for further expansion. It may not happen that in that very year they have identified a capex, or in the very year they have identified a project, but they have a plan that is in the next 3 years we would put in and they would do XYZ. So accordingly, then we will need to show that there is probability, I mean, the management perceives that this could be reinvested. It is not available for distribution, but in my so say for example, the first 2 years we assume that it is a good. So for example, I can tell you I have done a third model, which is the aggressive model, right? So here you see that there are robust cash flows available. Now I want to grow 10 times, right? I'm here already, I'm growing at a very huge pace and my working capital is supporting me. Now over here, because I've already taken my working capital impact, right? So my current business, whatever growth and that is being captured, otherwise my cash flow would have got decreased. Now in this case, that I say that I'm going to also reinvest this. So this 158, 228, I will reinvest so that the future cash flows will become 700, 800, 1000, and that will give me an enhanced valuation. But I have to then maybe extend my horizon to get to a stage where I believe that this will be, a stable growth kind of a scenario based on the current position. So that is how, sir, you'll have to do that.
Okay, thank you.
Yeah. So similarly, some other, there was one, as I said, a realistic projection. So this is a very realistic projection. It's a very normal 12% growth and a 10% EBITDA is very within the range of 14 to 18%. Now, in this case, when we look at the sensitivity, we see that it is only giving a 3% variation. So that means that this is within our comfort zone, because even with a lot of sensitivity, the needle is not moving much, right? So that means that the projections are robust enough to give us that comfort to give a valuation. Now, on the other extreme, when you have a complete aggressive projections, right, you're saying that you're going to grow at 15, 18, 20%, and then you're going to have a 15% perpetual EBITDA to revenue from 14% is going to go up to 24%, which you again believe is a sustainable 24%. Now, in that case, what happens to the sensitivity, right? Now, over here, because the year-on-year growth has been considered basis the past and there is no drastic jump, still it was giving you a valuation which is within the range. So both of these we have seen that, because none of the parameters are so way off that it is impacting my valuation to a larger extent. So this is still a comforting, okay, this is just a 3% change, or with the receivable and payable, it's just 8% change. So that, will give you a comforting position. So this is one thing on the trend analysis that I just wanted to take you all through. Next thing is on the also. So one second.
Ma'am, there is one question.
Yeah.
Can you please increase the capex in your projection without increasing the capital inflow?
Yes. So as I said, in my cash flow, I have not shown any capital infusion. No capital infusion comes in your cash flow. Yeah. Because that we are valuing only to understand what is the value of raising of funds. So I cannot put in that funds to find out. I have to first find out without the capital. I will project basis that capital. So even if you're making a balance sheet, I mean, you will show the additional funding, the gap, whatever is there, maybe as a loan or whatever. But when you are doing your projected numbers, your cash flow, that portion will not be considered as the inflow, because that is what you want to value. Okay. The next thing is that one is on the projections, and then you need to identify projections capture what? It captures your business. Now there may be some other assets, surplus assets, there may be surplus investments in your company, or there may be subsidiary investments. It could be in India, it could be overseas, UK, US. Now how do you factor these in your projections? So all the non-trade investments that are there, that is the strategic investments, you need to value them basis. Firstly, you need to identify which jurisdiction. So if it is, and the type of business. So if it is a complementary type of business, then you could, and you are having, it's like a holding company subsidiary relation, you could consolidate the cash flows together, and at a consolidated level, you could find out the valuation. But when it is a different jurisdiction, say for example UK, then you cannot do the consolidation, because you will have to value those cash flows separately. And the reason is that we are valuing these the Indian jurisdiction cash flows based on the Indian premium and the Indian cost of equity. The UK cost of equity will be completely different. So and the country risk premium is different. So accordingly, we will have to value that portion separately, and then we do the sum of the parts kind of evaluation. So that is something we need to understand. If there is a surplus cash, or if there is a surplus immovable property which is not used in the business, please also remember any land in the company, if it is being used for the purpose of business, you will not value it unless and until you feel that the value of the land surpasses the value of the building. So, I mean, we know that, all these companies which had properties on the mills, right? So the property valuation appreciated, but there was no business left, or there was very marginal business. Now you can't value the company based on a marginal business and say that is the only value. At that point in time, definitely you will look at the land value. But generally, an industrial unit, if you are doing a business over there, you will not value that land separately. You will only value those properties which are not being used in the business. That values needs to be identified and then added to the entire valuation. So these are some of the things which you need to look when you're analyzing the balance sheet, that what are these additional items that are there which will have an impact on my valuation. So these will be the adjustments to the valuation. Okay, so these are common mistakes that happens while reviewing the projections. And the first one has rightly, I mean, a lot of questions around it, that equity raise included in cash flows. So this is, a mistake that is done, that we never add equity raise in cash flows, because that will distort your cash flows. On the question that, which shares to be taken, That is why we always take the current shares and we do not take the expanded or the future shares that we are going to issue for that capital. Today's share capital will be considered and the equity raise will not be considered. You will take a post-money cash flow, that is the projection of the cash flow, bring it down to the valuation. Because you have not added a equity raise, that means it is a pre-money valuation. What does a post-money valuation mean? My valuation of the company is 100 and I'm going to raise capital of 50. So my post-money valuation now becomes 150. So for 50 on 150, I'm supposed to give 30% stake or 33% stake. That is a post-money. But what are we finding out? We are finding out this 100 portion. To find out this 100 portion, this is a pre-money value which you're finding out, and for that projections that you will be using are the desired potential. I would not say post money, I would say desired potential that you can do for those cash flows. So that is the concept of equity raise that you do not include in cash flows. Second is surplus income on surplus investments and cash considered. Now I have 10 crore or 50 crore of surplus cash, and on that I'm earning an interest income. Now, we should not consider this income into the cash flows and then in the terminal here, give the growth and give the entire valuation to that income. That is an interest income. You are valuing a business income. So how can you apply the same multiple or the same principle to both the income streams? You cannot apply the same logic. That surplus can be very well distributed to the shareholders, right? I mean, you need not earn that 10% or a 5% and then apply the entire multiple. So whenever you identify a surplus cash, you will not ascertain the income on that. You will reserve it separately as an adjustment. Only cash which is required for the purpose of business. So there may happen that bank requires an FD, bank requires a guarantee or bank guarantee or whatever. For that purposes, you need to reserve some funds in the bank. Now, when that is required, that is for the part of the business. Without that, you cannot run the business. So on that, whatever nominal interest you earn is an operating kind of a thing. So you need to identify and distinguish between surplus and between what is required for the business. That is like a capital requirement for the business, like a working capital which you require for the business, and therefore that needs to be considered. So this is one mistake that happens. Next is ignoring previous valuations or pre-evaluations or projections and not understanding the future sustainable growth. So what do I mean over here? So for example, if there has been a 1-year-old valuation done, it's very essential for us to consider that valuation. Even though if it is 1 year, we need to understand what were the projections at that point in time, how did the company fare, and what is the valuation that they arrived that time, and what is the valuation they are seeking today. I mean, it should not happen that that time they projected a high growth, they did not achieve it, and now they want a valuation still higher than the previous valuation. So how will you be able to justify when there is a precedent in place? So we cannot ignore a past trend that has been there or past valuation was that has gone to various authorities. We know for a fact today that income tax authorities are going after clients because assessment happens 2-3 years hence. So they are going after clients, comparing the valuation reports maybe 6 months or 8 months apart, and they are saying here you have shown X projection and now you're showing Y projections. That means this valuation projection has only been done to suit valuations. That is the allegation that the income tax department is levying. So it is very, very important to understand what data has gone out where, because that may land us in trouble. Next is consolidating all cash flows from subsidiaries irrespective of jurisdiction. I already explained that because of the cost of equity, you have to separate it out. This one, the next one is not reconciling cash with financials. I mean, this is a very
Ma'am, sorry to ask you again. I'm really sorry. Ma'am, in case, we have multiple subsidiaries in different geography, what should be an ideal methodology for an, valuer while doing the valuation?
Yeah, so we have to consider each jurisdiction cash flow separately, depending upon what is the business activity over there. So so whatever business activity, that cash flows you need to determine. Now, if it is just a branch office or a license office and everything, all the profits are being upstreamed to the holding company and there is only marginal profit left, then you may view it differently. But if it is a proper operating entity in a different jurisdiction, then you consider that cash flows separately. You apply the discount rate and the country risk premium for that jurisdiction. For example,
So you mean, ma'am, for each and every subsidiary has to be looked into as different cost center?
Yes, yes.
Okay.
Because the risk is different. In the US, the cost of equity is hardly 1% or 2%. So that you cannot compare to this jurisdiction. That jurisdiction is completely different. The growth rate over there, our economy is growing differently. That economy is growing differently. So it can't be compared like to like. You have to have a different approach for that. Yeah. So the next.
Hello. This is Nataraj here, Diana. I have a question. So with respect to any cash flows of subsidiaries, if the jurisdiction is India, so if there is a subsidiary which is operating in India and there is a stake involved, so should we take the cash flows or the income arising out of that subsidiary and add it to the cash flows of the parent company?
So if you're saying a third party stake is there in that?
No. Parent company, let's say 30% stake is there.
Then you can do the consolidation because it is India to India. Then you can do the consolidation and do a consolidated cash flow and then arrive at. That is okay, but provided they are both in the same business.
No. My question is not a consolidate. Should we consolidate? Or if we arrive at the cash flow of the subsidiary and take the percentage, like 30%, if the 30% stake is there, 30% of that cash flow can be added to the parent company cash flow?
Yeah, then you can do that.
That also can be done.
Yes.
Sir, subsidiary may not be growing at the same growth rate of parent company. So ideally what we are doing is, we are valuing the subsidiary separately, and subsidiary could have a different risk profile, subsidiary could have a different growth rate. So we value that differently and we add the total cash flows only for the discounting purpose.
Yeah,
Ma'am, correct me if I am wrong, please.
Yes. It all depends on that. That's what I said. If the subsidiary is in a like an ancillary which is completely linked with the parent company and it is dependent on the parent company and therefore the growth rate and everything is it's just an arm. Instead of having it within you, you have still for some reasons just kept it in a different entity. But otherwise everything is on a consolidated basis. Then you do it that way. But if it has its own risk profile different than the parent company, then definitely you value it separately. So it all depends on what is the nature of business of that subsidiary, how much it is dependent. Is it just doing a job work for the parent company? Then there is, it has got the least because it is completely linked with my parent company. But if it has got a different line of business with different customers and different growth rates, then definitely, as I said, you will value it separately.
Yeah. I am talking about the case where it's in a different line of business. And
then you will value it separately and
we will arrive at the cash flows and only the surplus cash flows will be taken into the cash flow of parent company. Is that correct method?
No. That is what Isor is also saying, that since that business model may be different, right? So when we are doing the discounting of the business, we are applying a perpetual growth. Okay, and we are applying a company risk premium. Now, these two factors may be different for that subsidiary company. So if I just add the cash flow, then I am, as I said, that we are applying the same growth rate and the same discounting to the same cash flows when the risk profile is different. Maybe the subsidiary has got some projects which are more
got it. If it is into similar risk profile but different businesses, then we can take the same cash flows. Even then, it is better to do the valuation separately, is what you are advising.
Yes.
Correct.
Okay, cool then. Thank you.
Yeah. Next is not reconciling cash with financials. So when we go with the indirect method, and we arrive at the cash flows, many a time it can happen. As I said, the biggest limitation is that it is prone to errors, right? And many a times I have seen that the cash flows that is shown in the projections do not match with the cash flows that is shown in the balance sheet. Now, there may be reasons that the projected balance sheet may have certain items which are not to be considered, for example, an equity infusion or whatever, and that is where the cash has increased. To that extent, there could be an adjustment. But ultimately, we have to ensure that the cash flow as per the discounted model tallies with the increase in cash flow or decrease in cash flow as per my balance sheet. Because otherwise, it is possible that I have missed. It is possible that I would have missed.
तुमको देती है, तुम करते क्यों नहीं हो? तुम्हें मार खाने का मन रहता है क्या? तो सीधे बताया करो हमारा.
Excuse me, kindly mute yourself and let the speaker speak, please.
Yeah, so that is one thing. Next, yeah. So, there was a classic case, though it is not this. So there was certain provisions which were being made, and that had got missed, while doing the working capital. So the working capital only considered like the trade payables and the receivables, but certain provisions which were being made. So you took the impact in your PAT or your EBITDA, but you did not take the impact when it came to the cash flow. So such mistakes can happen if you do not reconcile your cash with financials. So if you see over here, in all my in all the sheets, I have done a cash flow reco. So this ensures that the cash flow as per whatever is in the projection has been rightfully considered in the DCF model, and there is no component left behind. So with that, we complete the projections, and now we go to cost of capital. I think I've taken a lot of time on the projections. So as we know that, cost of capital has got two components, that is cost of equity and cost of debt. And the weighted average of that is the cost of capital. Now over here again, many challenges faced, because there are a lot of assumptions that goes in deriving each and every value. So first we start with, we need to have a cost of equity determined. Risk-free rate is still simpler. We get it, the government rate which is there. But cost of equity, the market premium, we need to find out. We need to find out the beta. So these are the two factors that we need to find out to arrive at the cost of equity. Cost of debt, still simpler. We get it from whatever is the current debt of the company, and we apply the tax rate to it. And then is the alpha that we apply, that is the company specific risk premium. Now this is required because the company may be market risk premium is ultimately you are taking a cue from the Sensex or the general market which is there. So you take the risk premium from there, wherein a lot of large companies are there. So the company which you are valuing may have a little bit different risk profile, or the size may be different. So for that, you need to apply a certain specific company risk premium. Now, in that, I'll just show you how different values affect the valuation. So as I said, that risk-free rate, I mean, you can get 10-year government from the RBI side and apply that. Now we need to find out beta, okay, and we need to apply levered beta, right? We always get an unlevered beta, and then we have to lever that beta basis our company and then apply that beta. So first, coming to the beta that goes into the valuation. So for one method is, I mean, Damodaran issues every year India specific beta and an industry specific beta as well. So you can get a beta from there. So for example, in Jan 22, there was a beta which was given as 1.59, or so this is one thing which is there. Or you can also take the comparable list of companies which is there in your sphere and find out the beta vis-a-vis the market volatility by applying the formula. That may give you a different figure. Now, if that changes, your entire cost of equity changes. So,
ma'am, in case of private companies, so it is not possible to get the basically rate of return at which it is difficult to calculate beta in that case, ma'am, right?
Yeah.
Because mostly we are getting valuation for private companies only.
No, so what happens is the CAPM will be because even the market premium that you're going to take, right? People take from what is the readily available. So if you have a Sensex, you will take a 20-year-old Sensex and find out what is the market return which the Sensex has given you over the 20-year, and then reduce the risk-free rate to find out the market risk premium. But ultimately, this is again reflective of listed entities and not an unlisted entity. So for an unlisted entity, there is a separate adjustment, a illiquidity adjustment, which you will have to do separately.
Okay, ma'am. And for calculation of beta, as you rightly said, like comparable companies are there, which are also in the private space, which are not there in the listed space. So in that case, is it possible to calculate beta?
No, private companies will not be able to find out beta, because what is beta? Beta is basically that how volatile is your stock
compared to market.
The market.
Right.
In a private company, there is no volatility, because there is no trading only happening.
Right, ma'am. So in that
So
case,
you will always take the benchmark. Now, Damodaran is also taking the list of entire listed entities, and maybe some public companies which would have traded otherwise. But from a private company, there is no information available to give that beta.
So, ma'am, what should be the right,
So that is what I said.
You are taking the levered beta and you are taking the unlevered beta and you are making the adjustment.
Yes.
So the debt component of your company will factor in.
No, that is separate, sir. That is separate. That is, I'm coming to it. But the first question is to get the unlevered beta itself is also a challenge.
Yes.
So unlevered beta can be in industry average beta, because see, all companies which are not listed, all companies which are not actually traded, they do not have beta. You can't compute. Even if you compute, that will not be authentic. For that matter, beta of 5 years, beta of 10 years, beta of 3 years will have a lot of difference. So you can see the oil companies will have different beta.
That is why I'm saying this beta is one of the most contentious aspect in the valuation, because this changes the entire game and everybody assumes this differently, and every assumption, right or wrong. I mean, one can say, Damodaran is also giving market beta, which covers many things, or you are saying you are taking an overall, from, as you said, the industry beta. Now, I'm saying we do not know. I mean, this is all probabilities which we are attaching that this may be the one, because ultimately it is an estimation. So definitely this is a challenging aspect of what is the actual beta. You're ultimately relying on some source to justify that I have taken from this source, which I believe would cover the risk which I am perceiving. So one may say that you should take a industry beta, but all industries may not be available. So then you may go then how do you take beta? Then you'll have to rely on a general beta, and then bring it down to whatever for example, this Damodaran gives you the industry specific beta, because ultimately every industry moves differently. Right now, either you calculate or you take it from a source. Now, when you calculate, there may be errors, or there may be not the complete picture that you may take. So that is why we rely on a third party source to say, okay, this is something which has been a study, it's a source publicly available, and it can be justified by saying that it is a publicly available information which we have relied upon. So rightly so, that this is the most contentious thing of using a beta, and it can vary your valuation drastically. Now, once you get the unlevered beta, the second thing is, even to relever the beta as per your company risk profile, there are three questions. Relevering is what? Is relevering to your debt equity ratio, correct? Now, in that also, there are three options. Which debt equity should I take? Should I take the current debt equity? Should I take the average debt equity across the horizon period? Should I take the target debt equity? So again, different debt equities will make my beta from 1.59, it goes to 1.97.
Ideally, as you said rightly, like even if when we do valuation, we should not consider investment from outside, as you rightly said.
Yes.
Yeah. So ideally, the beta, the leverage should be the current one, the current leverage which the company is having, instead of going to the target debt equity ratio. That is what I can,
No. So what the actual practice says is that you should take the target debt, because ultimately that is where as an industry you have to move towards, and that is the ideal one which you want to achieve. And that is, say for example, by the terminal year you are achieving your target debt equity ratio. Now your entire valuation is based, that WACC is being used on that terminal year. So how can you use a WACC which has got a debt equity of the current, and you are discounting it to a cash flow in which your debt equity ratio is completely different?
Okay.
So there the view is that we have to move towards it, and I have to discount that cash flow based on what debt equity I had considered.
Okay.
We usually take the target debt equity and apply it all across, but some people do a refinement wherein, if I am, say, in the initial 2 or 3 years, I'm a high leverage company, and then I have tapered down, and then I have achieved my target. Now for the first 3 years my WACC can be different. So the question is, can I have a WACC different from my first 3 years and a different WACC for my terminal year and whatever target where I have achieved? Answer is yes, you can do that if there is a huge variation in your leverage ratios. So we have to understand, how is my leveraging moving? So see over here, when I have said here, how my WACC moves because of the beta differences. So even your WACC is having the debt equity component, right? So one is in the beta, there is a debt equity component because of relevering, and in the WACC also you are doing the proportion of debt equity. Now even that will change. So with the beta changes, so you can see the WACC is moving from 14% to 23%. Just the company has got nothing to do with it. Company is as is, it is the projections as is. Only your cost of capital assumption changes is leading to a WACC from 14% to 22%. So ideally, we see the target debt equity, which is in this range, and from
So, ma'am, this is one of the important question that need to be asked at the time of valuation. That what should be the target debt equity ratio from the client?
Yes. So over here, target debt equity, say for example, I was today highly leveraged. I'm at 50%. but I know that eventually I would reach at 15%, and that is the sustainable way. Because if I am highly leveraged, how can I say that that is going to go on for perpetuity? My business will vanish. When I'm doing my terminal here, I have to ensure that I have a comfortable capital structure so that that can take me through all the years in future. So that is why you have to have a comfortable target debt equity ratio. So 1.59 is what is to be compared with this. So 16.4 versus 19.9. Now again, so this was on beta. Okay. Now we go to market premium. Now market premium also, one method which I told you was based on this market risk premium, which is a simple method. You take the BSC and you get it. You know, if you don't do much adjustments, you get the CAGR which is there. So it's a 9%. Damodaran has given India specific risk premium. It comes as a separate source, which says 6.4%. There is another site which is indiariskpremium.com that gives another risk premium to India. So using two valuers will use two different market risk premiums and will get different WACs. So as I said, unless and until standardization comes in all of these things, there's going to be a variation in terms of what is your cost of equity. You can see the cost of equity is moving from 17% to 25%. So that's a huge variation that is coming about due to these assumptions. So as you can see over here, that the discount rate, that the range that I showed you, that 17 to 22%, so 18 to 22%, the discount rate depending upon the growth rate can take your valuation variation from 8 to 11%. So there can be that change depending upon how aggressive your valuation is or how conservative your valuation is. So here it increases because I had a aggressive valuation. So here it increases to 10 to 13%. So this is something that we need to be careful about on what is the discount rates that we are using. So these are some of the aspects that I had covered. Again, tax rate, it has to be the tax rate which we believe is going to sustain in future for relivering the beta. No uniform benchmark for market risk premium, difficult to estimate beta, especially with companies with high leverage. The next aspect is the perpetual growth rate. So again, what should be the perpetual growth rate? Can it be 7% in a time when India GDP was 7 to 8%? Could I have had a growth rate of 7 to 8%, or it needs to be a nominal 1 to 3%? Is another question that needs to be addressed. So definitely you need to again look at how your projections are. What kind of industry are you? I mean, if you believe that even at the end of the terminal year, you are in a very your market share is minuscule and you have a huge potential, you may, but ultimately you are also valuing it in perpetuity, right? So you have to be mindful of that and therefore decide what is the range of perpetual growth that are going to take. So it's always definitely has to be lower than the country's GDP, and we usually keep the growth rate anything between 1 to 3 or 4%, and unless and until, because ultimately you are saying that your terminal year should reflect a stable year. So accordingly, you will have to then taper down your growth rate.
Ma'am, is your terminal rate should commensurate with the industry growth rate of that particular sector?
No. So that industry growth rate is not a perpetual growth rate, no?
Okay.
So that is a year-on-year growth rate. So that can be there for a certain period wherein you are saying ki today I'm 10% of the market, tomorrow I'll become 20%, and the industry is also growing by X percentage. But ultimately, as I said, there will be a stage wherein you will have to have you can't sustain the high growth forever, as I had said earlier. So from that perspective, even an industry after a certain point in time start getting stagnated unless and until future capex is done or future things. Now when you're doing a projection, you have only estimated for that period what capex and what you're going to invest, right? So to get a higher growth, that will be going beyond, so that will come in the future years. But for now, from what you're sitting today, you can only estimate what is in the next 4 to 5 years. Beyond that, it's nobody's guess. I mean, anything can happen. We have seen companies that have done so well, but after 3 years, you don't even hear those names of those companies. So anything can happen, in the future. So that is why you cannot estimate that high growth will be sustainable forever. Next is terminal value. As I was mentioning that terminal value is something which is the major portion of your valuation. So in that case, what are the various methods? The normal method is the Gordon growth method. So what we do is that we capitalize the terminal here by the discount rate minus the perpetual growth rate, and then we discount that terminal value to the present value. That is the Gordon growth method. Now there is a separate method which is called the exit multiple method. Now in this method, what happens is you don't do the capitalization of the terminal here. You take the EBIT or the EBITDA or the profit or whatever is the multiple, you take a multiple based valuation. Say for example, a venture capital has invested, and if a venture capital wants to exit after 5 years, what is the multiple that a venture capital or a private equity player would give for that business? So you apply that multiple and get the terminal value and then discount it to today's value to get the current terminal value. So this is one method, but the idealistics of DCF actually say that exit multiple, then you're not doing DCF. You're actually doing a different method, right? You're doing an exit multiple method where you're comparing the comparables of different companies and getting this. So some people do it, but that may also be the case in some situations wherein DCF may not be the correct method. But regulatory perspective, you have to do a DCF. Then what do? You have to get a valuation. So in that certain circumstances, you may have to do an exit multiple method. And people are doing it in some cases, and therefore, it can be taken into consideration. The third is a liquidation method. So it can happen that you are supposed to value a company which is in a degrowth phase, right? So for example, if there was the Kodak camera or a roll company which now today hardly is being used, right? So that has got the entire product has vanished. Now when the influx of the new technology comes in and you are at the inroads of a decline, it may happen that you would see, okay, this business may max go to 3 to 4 years. And at that point in time, you will have to liquidate. And then, so this business life is only so much. So in that case, you will not do a growth model. You will do a liquidation method wherein you will say, okay, I will run this business maybe for 3 years at a tapered growth or whatever. And then at the end of 3 years, I will exit the business by liquidating, and you get the liquidation value and discount it and get your terminal value. So these are the different ways that you will do the terminal value. Yeah, so this is the question which some people had asked in the beginning, was the premium and discounts that will be levied. So First is lack of marketability. So of course, since you're valuing private companies and you have taken the market premium, the beta, etc., from relating to public companies, so you will have to add a discount to the illiquidity of the companies, because those returns are based on a company which is liquid, right? There is a trading facility available, there is a ready buyer available. Here you do not have that buyer, there is no price readily available. So from that factors, you have to factor a liquid discount. Now over here again, anything between 15% to 25% to sometimes even 30% is the lack of marketability discount that is levied on companies. Then is a discount for lack of control or premium for control. So you have ideally the market risk premium that you get is based on the minority shareholders, because usually the minority shareholders are trading in the companies, and these are the returns which the minority shareholders intend to have on the companies. So that is how you get the valuation based on the minority perception of the listed entities. Now, if for example you are buying more than 50% stake, then you will have to add a premium for control, because a control has got an additional value. A control can determine the course of the company. The control can determine the mode, the cash flows of the company. The decision making power is with the person who intends to acquire control, and therefore any promoter who intends to hand over the control will ask from a premium, because the other person is getting a control. So there is a premium for acquiring control. There is a premium sometimes, to some extent you can give some premium to the investor, if a strategic investor, if there are going to be some synergies that are going to come out from the acquisition. So for example, there was a case wherein we knew that this kind of a merger would eventually help the company in reducing its electricity cost. Right. So at that point in time, maybe you would have to capture some element for that, because that is the premium that is there. So these are some of the things. Discount for lack of control. Sometimes when you're purchasing a minority stake, you may try and apply that, though I had said that there is a minority stake perception, but yet that may be a smaller portion than what this business may command. So depending upon what is that percentage, you may apply that discount.
Excuse me, ma'am.
Yeah.
Ma'am, if there is an angel investor and he wants to value a company for the purpose of investment,
yeah,
whether he should apply D-loom in that, or he should take exit multiple in the terminal value, what should he do?
So if it is a startup,
yeah, you can say it as a startup.
So that is my next slide, where instances and sectors where DCF is not usually used.
Okay.
So I can take that slide. So as I mentioned over here, if there is a startup, if there are companies with high cash burn, right? If there are finance companies, now this is one difficulty we are facing. For example, if there is a NBFC which is into a lending, now cash only, it's his business. There is no surplus cash. Every cash is reinvested in the business to deploy more funds, to get more loans and to get more interest. The parameter of valuing a NBFC is usually, you have to see the NII, that is the net interest margin. You have to see the value to the book values, that is the price to book value. These are some of the parameters that are used for finance companies and not DCF. So in that position, what do you do? Startups, as I said, that startups have got a huge uncertainty. Then what will you do? How will you value a DCF? Because the promoter or the entrepreneur completely believes in his business. For you, it's a completely new thing because there is no precedent set. You don't know how, there is no past traction. You don't know how it will fare, whether the market will accept it, not accept it, what stage it is. So how will you value it based on DCF? Because then those are just numbers. I mean, it's just a narrative that has been given, and you have to rely on that narrative. That becomes a highly subjective and uncertain kind of a valuation. So then there are holding companies. Now, holding companies, you can't do just based on whatever dividends are being received. One position may be that because it is just getting dividend, you just do a discounted cash flow, but still you're undervaluing most of the underlying investments that are there. So you would individually value those independent businesses and then do a sum of parts and then apply some discount, because holding companies generally the sum of the parts is not equivalent to the total, because the companies believe there are so many holding companies that are there that are trading at a discount 30%, 40% to their investments. They are holding all listed in companies as investments, but they are being traded at a discount. So there are different principles applied to a holding company. Research driven companies, you are investing into something which is completely unknown. It may either, it's just like a startup, because either it may kick off or become a blockbuster, or your entire energy, entire money is in the drain. Asset heavy, long gestation period companies. So something which has a long gestation is a 10-year. There's a oil company which is into the oil fields and mining and all of those, which is a lot of gestation period. We do not know what you will get, what would be the reserves, what will be the pricing. Commodity pricings are so volatile. So how will you value this basis or DCF? And then the last is the liquidation, which if something which is ripe for liquidation, definitely you will have to value on an as is where is basis. So there is something where you will not be able to use DCF. So these are some of the instances where you cannot use DCF. Now, one thing which I missed is to show you all. So as I was mentioning that, different DCF throws up different valuations. So how will you, have that comfort in terms of that what should be the, probable value? So it's always better to compare it with a separate method. So you have a multiple based method. So this is, I have just created. So the same three scenarios or which were there, which is your conservative, realistic, and aggressive. So the current EBITDA is this. On this, if I know ki the industry average multiples ranges from 4 to 9%, then basis that and whatever debt is there, add cash and everything, I get to a valuation based on a multiple based valuation. And then I compare this valuation with my DCF valuation. Then what is the delta that is there? That will also give you that comfort whether you are completely off the mark. As I was saying that DCF does not compare with the comparable peer, but having said that, that intrinsic value should also justify. I mean, market is not just going in silos, so it has to, unless and until there is a completely different reason, but usually the valuation should be in the range of different methods, and that will give you a comfort. So for example, as I said, this shows based on even though I have taken a very low multiple of 4 multiple, it still gives me a 16 crore valuation, and this is giving me a 7 crore valuation for a 5-year period. This one is in still range. It's an 8% different. I'm ignoring the 3 years. It's an 8% difference, and this is a 6% difference. As I said, plus and minus, it can be somewhere in the range. So this gives you an additional comfort that you can take when you're doing the valuations. Then I think so one last, so I have covered all of this. I have covered this. Now, last which was left is the number of equity shares. Now, on this, just one point which I would like to mention is that what happens when you have a convertible instrument. So this assumes that you only have a plain equity shares, but what happens if you have a compulsorily convertible preference shares or a
September.
So in that scenario, it is not right to just take the current share capital and only treat it as debt and completely ignore its value and derive at the value per share. So for example, darn it, let me just check. Okay, I will just do it right now. So for example, okay, this is showing a 107 rupees is the value per share. Okay, okay, and the number of shares is 30,000. Now, what if there is additional component which says that you have a CCPS? So say for example, you have 30,000 CCPS, okay, which is going to convert 1:1. I'll just take a simple example that this CCPS is going to convert into 1:1. So eventually after conversion, you will have 60,000 shares and this CCPS is entitled to 50% of the value. So today, you cannot take 30,000 as the base. You have to consider the fully diluted number of shares to really determine what is the value per share of the equity. Because there is already a dilution for the equity shareholders. This entire value which has come is for both the shareholders, that is the CCPS holder as well as the equity shareholder. So you can't just minus the face value and say that the balance, everything belongs to the equity shareholder. That will really give a very wrong picture for the purpose of valuation. And this is a challenge that we are also facing in income tax. So income tax 56 to, I'm just digressing, but income tax 56(2)(10) also does not give you the leeway to do any adjustment to the number of shares. So it does not consider the fully diluted basis. I've just written an article yesterday in Tax Sutra, which has come, in which it explains that you always have to consider a fully diluted basis value for that share. Otherwise, you are loading the entire value on an equity shareholder when that may not be the case. All the private equity shareholder, private equity funds, venture capital funds, they come through convertibles. So are we saying that they are only entitled to face value and the entire equity share value is to the promoters? No, that is not the case. So you have to ensure that if there are convertibles, if it's an optionally convertible or if it's a compulsory convertible, appropriate adjustment is done to factor the true value of that instrument. So this is one thing which I really wanted to highlight, because I've seen mistakes even on happening on that, wherein the convertible portion is not considered. Yeah, I think with that I come to the end of the session. And I just really liked this, that, what will happen if someone starts questioning all the assumptions. So I hope that it doesn't happen and we take utmost get the best possible we can in valuing the DCF model. Yeah.
on the CCPS thing, if the conversion is post the valuation date, then obviously we need not consider the converted portion on the CCPS, right?
No, we still have to consider, though it's a post event, but already that interest is already there in the share. In case of usually on all of these CCPS, they have, you know, a liquidation preference and all of those given. So ignoring that will not be right.
Okay.
So, any more questions? I think she has taken all the questions during her explanation only.
Right.
So, I will propose vote
There
of
is
thanks with the
one,
permission
Yeah,
of.
one
one or two
question
questions
has
are
Please, please.
there, ma'am.
Yeah, two questions that for only DCF is applied. Well, it is not that it is only applied. There are various other methods. It is just done to get, you know, a gut feel. See, ultimately, as a venture capitalist, you would want to know what is it going to generate. Right now, but for example, you can take all the big startups of, I mean, Flipkart and all of that. They're not even startups today. They are still doing a high cash burn, but I don't think so they could have ever been valued based on a DCF. So they usually will do that exit multiple method. So it is not pure DCF because it is not calculating the intrinsic value. It will do its you know, basis ki what is the potential, what is the intangible valuation, and basis that you know, that is what it will do.
Ma'am, Priyanka has asked that please share the name of the paid site for getting exit multiples.
Exit multiple paid site.
Yeah.
So VC Circle and there are some other sites which you know, give you transactions wherein they report the transactions and give you the multiples at which the transactions have taken place. So from those sites you can get the multiples.
What is the percentage of lack of control one should, you know, consider?
So anything ranging between, you know, depending upon how much, whether you are a, you know, say a 40% shareholder vis-a-vis whether you are a 2% shareholder, right? So, and what rights you have as a minority, you may also certain times have a affirmative right or things like that. So you have to see what rights are available. If it is a complete minority and if it's a very small stake, then you will give a higher discount. So anything between 10 to 20% discount you will give.
Okay, ma'am. Thank
you.
you.
Madam, I have one question. I don't know whether it is very fundamental or some conceptual understanding issue with me.
Yeah. I can't hear.
Hello?
Yes, sir.
You are adding alpha rate in order to decide the effective WACC rate. Number one.
To the cost of equity.
Yes. Yeah. Number two, you are also adding the lack of control kind of a premium to the price thereon. Is it not amounting to, you know, doubling kind of a, you know, the entire burden on the entire valuation, madam?
So there are two different aspects. So one, the alpha is to ascertain the riskiness of the business, which has got nothing to do with the control. So a business may, because in the business in which it is high uncertainty, or you know, the projections may look very aggressive. So things like that, wherein you would need to discount it to get that gut feel. At that point in time, you would put that alpha. So that is very company specific, nothing got to do with the purpose. So as I said, this lack of either control premium or control is when you're doing it from the perspective of a particular shareholder. If you're doing without if say for example RBI says ki just do a fair value, or income
Okay.
tax will do a fair value of shares, at that point in time you will not add this unless and until you're doing a valuation for the investor for those shares. So
Okay.
when you're doing a fair value of these shares, you will still add that alpha, but you may not add the control premium and all that because you don't know who's going to acquire it.
Okay. So control premium is from acquirer's perspective.
Yes.
Alpha is from the fair value perspective.
Company perspective. Company
Company perspective. Okay.
Yes.
Okay. Thank you, madam. Thank you.
Yes, Kishorji, I think now you can propose the vote of thanks.
Yes, sir. Thank you. Thank you, Miss Diana Matthias. You've done a fantastic job. We could see a mini Ashraddha Modran session, if I may take liberty in stating so. It's so nice. And some of the aspects like how the value changes with sensitivity is something which we don't get to see from many of the speakers or most of the speakers. That's a very highlighting thing. And your presentation is so eloquent, good, eye candy. In fact, the color combination, everything is good. And you took a lot of time, I think more than 30, half an hour you took more.
I hope I've been able, still people are there to listen.
Yes,
and
yes,
have not bored them.
And we see all the participants still there. Thank you so much. I'll request Sandeep ji to plan another session, maybe as an extension of this, because this is so interesting. And there are some more doubts which are still there in the minds of many of our participants. They could not ask them because of lack of time, lack of courage now, or they thought they require a bit of preparation to come back and ask. So it doesn't matter. In fact, we have to respect.
Always ready to come back to this platform.
Ma'am, please take a session on data.
Okay, sure.
Ma'am, will it be possible to share the Excel which you have prepared? It's very nice, ma'am. I haven't seen such kind of analysis,
True,
Sure,
ma'am. It's very insightful session.
Yes, ma'am.
Thank you so much.
So thank you so much again, and thanks to our leadership for organizing such a nice session, a good
Yeah,
speaker.
please thank Bhaveji again on my
Very, very true, very true. In fact, when I was noting down the points, the serial number went up to 30. Very interesting. Good inputs, madam, really. I mean, thank you very much.
Thank you, sir.
So thanks to all of you.
Thank you, ma'am.
Thanks.
Thank
Good
you,
night,
ma'am.
ma'am. Thank you so much.
Good night, Take care. Bye.
Bye.
Thank you very much.
Kuch nahi.